Every nation on the planet now lives inside red ink, from superpowers to city-states, from exporters flush with trade surpluses to countries sitting on oceans of oil. And the sheer scale alone feels absurd. Tens of trillions owed by the United States, trillions more by Europe, Japan, China, and everyone else combined into a global total that towers far above the value of everything the world produces in a year. And this leads to the question that sounds simple, but is deeply unsettling the longer you stare at it. If everyone owes, who exactly is being paid? This is where financial history stops being about numbers and starts being about power. Because debt is not a mistake layered on top of the modern world. It is the frame holding it together. The invisible skeleton beneath wars, welfare states, stock markets, and empires. And once you trace the trail of IOUs far enough, you arrive at a paradox. The world largely owes money to itself, yet the rewards and punishments of that system are distributed anything but evenly. To understand how we reached a moment where global debt exceeds 3 times global output, you have to rewind past digital money and credit scores to a much older invention, born in desperation, not innovation: war. In the late 17th century, England, starved of gold and locked in conflict with France, did something radical. It promised future tax revenue in exchange for immediate cash. And that promise was formalized, traded, and institutionalized through the creation of the Bank of England, giving birth to the government bond, a financial instrument that transformed state power forever. Other nations quickly learned the lesson. France adopted it, the Dutch optimized it, and the young United States used it to survive revolution and expand across a continent, turning debt from a sign of weakness into proof of credibility. Because the ability to borrow signaled the ability to command resources far beyond what a treasury currently held. Empires no longer needed to conquer gold mines when they could issue paper claims on the future, converting political authority into interest payments and shifting the battlefield from soil to spreadsheets. Fast forward to today, and debt has become the world's most universal product, with borrowing accelerating relentlessly, every country issuing promises, every bank recycling them, and every citizen participating whether they realize it or not through taxes, savings, pensions, and insurance, making nearly everyone both debtor and creditor at the same time. Take the United States, whose debt is not merely national but systemic. Most of it is held domestically by funds, banks, insurers, and its own central bank, while a smaller but symbolic portion sits abroad in the reserves of countries like Japan and China, meaning that when Americans pay interest, much of it flows back into American institutions, retirement accounts, and balance sheets, creating a closed loop where the debtor and creditor wear the same face. This reflexive structure is mirrored globally, with nations lending to one another through treasuries, development banks, and reserve holdings, forming a circular chain of promises where each IOU is backed by another IOU, like a table where every player is both borrowing chips and lending them onward, sustained only by the unspoken agreement that no one flips the table. Looming over this web are the markets themselves, vast, impersonal, and decisive, where pension funds, hedge funds, sovereign wealth funds, and central banks collectively decide who may borrow cheaply and who will be squeezed, often with consequences more immediate than elections. Because when confidence evaporates, currencies fall, governments stagger, and entire societies are forced to restructure overnight. At the heart of this system sit central banks, which do not simply manage debt but actively create it, swapping newly issued money for government bonds and ensuring that every unit of currency represents someone else's liability, making truly debt-free money a myth, since every bill and digital balance is ultimately an IOU in disguise. For decades, this arrangement has survived on belief rather than resolution, because investors do not demand repayment of principal so long as interest flows and rollover remains possible. But history shows what happens when faith breaks, as seen in Greece's austerity spiral, Argentina's serial defaults, or Sri Lanka's collapse when foreign currency ran dry. Moments when the abstract idea of creditors suddenly becomes painfully concrete. Yet, even after crisis, the logic persists. Debts are restructured, maturities extended, new loans layered on top of old ones. Because in the modern era, sovereign debt is not meant to disappear, but to be perpetually renewed, a rolling contract where interest is the true commodity and stability its price. Governments do not plan to erase their balances, they plan to service them indefinitely, refinancing old obligations with new ones, much like a subscription that is never canceled. Because paying everything off would drain the system of its safest assets, shrink the money supply, and trigger deflationary shockwaves through banks, pensions, and markets worldwide. A government bond is therefore less a burden than a cornerstone, treated as near money itself, and the entire financial architecture relies on states continuing to issue them in a steady rhythm, turning public debt into the heartbeat of global capitalism. This is why promises to eliminate national debt are theater rather than policy, because the real objective is not absence of debt, but its credibility, sustainability, and desirability, the maintenance of trust that allows the numbers to keep growing without panic. But trust does not flow evenly, and while nations may owe themselves in aggregate, interest payments move upward through society, from taxpayers and workers toward institutions and asset holders, tying the rise of global indebtedness to the rise of inequality. Debt, in this sense, is not just an international ledger, but a class mechanism, rewarding those who own claims and burdening those who service them, a pattern repeated from households to governments to the planet as a whole. There is no single villain at the top of this pyramid, no solitary hand pulling the strings, because the system is collectively built, collectively maintained, and collectively depended upon, blurring the line between who owes and who is owed until it nearly disappears. Debt once signified bondage. Today it signifies balance, but that balance is fragile, resting entirely on confidence. And if that confidence ever fractures, the elegant abstraction dissolves, revealing debt for what it has always been beneath the layers of finance. A promise stretched across time, powerful so long as it is believed, and dangerous the moment belief runs out.